Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is March 10 and this is a weekly markets update. Let's have a look at the news of week 10 and see what are the next trends. Speculations about Indian urea purchase tender continued this week, weighing on market prices. Now every day is discussed as this last day before the tender. Many people say the tender will emerge this week, but we heard that many times already, so let's see. Urea prices softened across the globe. In Northern Africa, there was no fresh business concluded last week, but some producers are understood to price their product around $435 to $45 FOB. No new sales out of Nigeria was done as well. Ethiopian ABC has scrapped its tender for 300,000 tons supply. In Europe, import activity was subdued as buyers are waiting for market destination clarification. Also, weather conditions were not favorable in the past couple of weeks, postponing distribution demand. Cold weather in the southern Europe, rains in Spain and Italy, all this gave a pause to new import purchases. The refill purchases are expected to massively start in a couple of weeks from now. In the Middle East, indicative prices also decreased to $410 to $15 level. But only actual deal was conducted. Qatar Energy closed a sales tender at $415, but it is unconfirmed figure by either side of the deal. Other than that, producers are waiting for the Indian tender. In the Southeast Asia, the bearish sentiment was set by Indonesian sales tender for 45,000 tons of urea that was finalized at $399 FOB. Earlier, the producer was targeting $430 level and scrapped the tender with proposed $410. Activity in other parts of the region was very slow last week. Australian purchases were also subdued. On top of that, ongoing supplies of both urea and phosphates were disrupted by the cyclone that made landfall on Friday in South Queensland. Farmers held fertilizers application due to heavy rainfalls and flooding. In Iran, cold weather starts to retreat, so gas supply to the industry is supposed to normalize during these 2 weeks. So, Iranian fertilizers producers will fully come on stream around end March perhaps. It will ease the supply stress when India will come out with a tender, and other regions will start active buying season as well. FOB run price last week was indicated at $388 to $90. In the US, barge price softened by $5 to the level of $389 to $95 FOB for short term. It happened because traders started to send tons to the US while waiting for the Indian tender to emerge. However, US importers are worried if the country is able to import as much urea as it will need, taking into account record high corn acreage and current delay in terms of imports. Also, big concern is related to the recent regulation of Trump's administration about penalties for all Chinese vessels and companies operators entering US ports. This will influence not only container vessels that we discussed a week ago, but all vessels including dry bulk. This regulation might appear during the hottest period of fertilizers imports in the year, and uncertainty about its implications might discourage vessel owners to send their vessels to the US at all. Another potential disruption might happen with supply from Canada that will mostly influence northern US regions. So, too many questions, too little answers. Brazilian market was on mute due to the carnival, but indicative offers also decreased in line with global sentiment. Small lots changed hands around $410 CFR, but buyers' bids seem to be already at much lower level. But the main purchasing activity is only expected to emerge in April onwards. Paper values dropped across the benchmarks in line with the general bearish sentiment. Egypt FOB future for March decreased by $10 from March to the average of $425 and remained unchanged for April. Nola values dropped by $9 from March to the average of $388 per short ton, and also remained stable for April. Arab Gulf FOB future values for both March and April slipped by more than $10. Brazil CFR remained unchanged due to low market activity. Ammonium sulfate price moved slightly down last week due to weak demand from all key buyers like Brazil, Turkey, and Southeast Asia. FOB China standard product cost fluctuated between $144 to $48. There was a sales tender from Chinese producer SCC awarded at $144 FOB. Another tender from Chinese producer TCC was finalized at the similar level, which is a tight range for AS in China. In Europe, supply of granular product continues to be tight, but general bearish sentiment in the nitrogen complex is weighing on prices. They remained largely unchanged versus a week ago. Standard product at 175 to 90 euros Northwest Europe, granular at wider range of 240 to 70 euros. In the US, market activity was limited last week. Activity in Nitrates segment was again slow last week, as application season is on the way. Producers appear to have pressed pause on price increases after some pushback from the buyers. There could now be downward price pressures in some places, like in the UK, because grain prices have dropped, and also due to decreasing price of natural gas. The weather in the UK has finally become a bit drier, so application has resumed and is in full swing. Distributors are under tremendous pressure to deliver. In Italy, demand is still impacted by heavy rain in the last 2-3 weeks. In Germany, CIN prices stabilized as application is on the active phase and no new inquiries emerge for now. UAN prices in Europe remained unchanged and there is little demand for any fresh tons, as season is on its way. In the US, prices were steady both at Nola and in most locations inland. However, tariffs for Canadian imports keep the uncertainty high and might pull prices a bit higher. At the same time, urea price that decreased last week has reduced market participants' expectations of further price growth. In ammonia, market downward price trend continues. Northern African values slipped more because perhaps the lower than $500 FOB, which is the undisclosed level of last deal conducted by Yara. Prices in the Middle East stabilized in the range between $305 to $35 FOB. Certain immediate pressure was off the producers' shoulders, with small sales here and there, but generally the sentiment continues to be bearish. Demand from Southeast Asia is still weak, so there is not much hope for upward correction anytime soon. In India, FACT awarded its tender for 8,000 tons at $375 CFR. Elsewhere in India, the demand is sluggish. With such trend, we might soon see the bottom, where producers in the Middle East will reach almost their cost level, and then perhaps some closures might take place. In phosphates, the main news of the week was massive sales of Ma'aden to multiple destinations, while Moroccan volumes were almost absent. Ma'aden sold 170,000 tons in total, out of which 30,000 to Nepal, 60,000 to India, 44,000 to the US under formula, and 40,000 to Argentina. At the same time, it is understood that discussions Indian buyers with OCP are ongoing, most likely coming to the end. Seems like most details of the deal have been agreed, but specific allocations are yet to be finalized, which is the reason this is taking so long. Any agreement will be on a formula basis, changing paradigm for India. If this is concluded, it will mean a big portion of imports will be on formula, as opposed to spot deals. Last week, India bought from Ma'aden and also 30,000 tons from the Russian producer. Prices increased to $636 to $39 CFR. Ethiopian ABC has rejected revised bids for DAP as they did not meet target price of $625 FOB. It is unclear yet if they may have scrapped the tender or if they will retender. NCAC in Egypt concluded sales tender, selling DAP, TSP, SSP, among other cargoes. prices heard increasing for SSP and TSP, while DAP price was already high in the last tender, so further increase will be very difficult to push through. Chinese producers proposed a lot of DAP to the Ethiopian tender with Laken in May, suggesting that exports will resume at that time. However, there is no official information available yet. Current offers out of China stand at $630 to $40 FOB. Brazil was out of the market last week due to Carnival. Prices remained unchanged. In the US, most prices increased slightly due to unfavorable weather across the country that postponed demand. Both MAP and DAP barges traded at the level of $610 to $15 per short ton FOB for March. In Europe, phosphate activity was minimal. The other concern in phosphates market was related to sulfur cost, which is going up tremendously and affecting phosphates prices. Chinese importers rushed into the market after Spring Festival in order to secure tons at growing trend, and Indonesia increased imports for EV sector. Sulfur price will be an important factor that will support elevated phosphates prices during the year. Moving to the fundamentals. European natural gas futures dropped to the 5-month low of 37 euros per megawatt hour over the course of the week, amid a series of summits between EU members that raised optimism about Union to identify alternative gas sources outside of Russia. Additionally, gas prices were also lower this week amid warmer weather through the continent, easing demand at the end of the winter, and the possibility that the EU would be less strict about storage targets in coming years. But then price rebounded on Friday to 40 euros after Russians struck Ukrainian gas infrastructure with drones and missiles, threatening supply to EU members that still receive gas from the transit area. US natural gas futures retrieved a bit from 25-month high of $4.5 per MMBtu on Friday, following US Energy Information Administration data showing a smaller than expected storage draw. Despite record production of almost 105 billion cubic feet in February, storage levels remain 25% lower than a year ago and 11% below the 5-year average. LNG exports also surged to a record 15.6 billion cubic feet last month, supported by new capacity at Plaquemines plant. However, forecasts for milder weather through March 18 are expected to curb heating demand. Agricultural commodities future prices restored after significant decrease at the beginning of last week. Wheat futures rebounded to $5.33 per bushel level, recovering from a 6-month low reached last Tuesday, as market sentiment improved following signals that US tariffs on Canada and Mexico might be reduced. Meanwhile, tariff war escalates and China imposed tariffs ranging from 10 to 15% on various American agricultural and food products in response. At the same time, Australia has increased its wheat production estimate for the 24-25 season by 2.2 million tons. For the next 25-26 season, production is expected to fall but remain above the long-term average. Corn futures also rebounded to $4.55 per bushel, driven by a weaker dollar and easing trade tensions with Mexico, the top importer of US corn. Meanwhile, traders assessed global supply conditions with strong harvest progress in South America. In Brazil, favorable weather accelerated the 24-25 soybean harvest, clearing the way for expanded second crop corn planting. Additionally, improved rainfall forecasts for Argentina raised expectations for a stronger corn yield. Market participants are now awaiting the USDA's upcoming supply and demand report tomorrow, which will incorporate the latest trade policies in its grain forecasts. Soybean futures price rebounded as well after last Tuesday's record low and reached $10.1 per bushel on Friday, almost similar to the week ago. The main uncertainties regarding tariff war prevail in soybeans trading as well. In the anticipation of USDA's report that will be out on Tuesday, traders looking for no major changes to the US numbers. Market analysts estimate Brazilian producers have sold more than 42% of the 24-25 crop, which is ahead of same time last year. At the same time, Brazilian February exports total was slightly down from last year. Chinese soybean imports during January and February totaled 13.6 million tons, fairly the same amount versus a year ago. Moving to the shipping industry. Containerized freight index continues its downward correction, started at the beginning of January. Price decreased for all key destinations, but again the sharpest drop was for destination from China to US ports. The market is still chewing the news about proposed penalties on Chinese carriers and operators that we discussed last week. For now, there is no clarity regarding when this regulation will be actually put in place. However, it seems like this document is a result of agreement between Republicans and Democrats, who believe that Chinese influence at maritime trade flows has grown big time, so it will go through perhaps. According to the Center of Strategic and International Studies, Chinese shipbuilders account for more than 50% of all merchant vessel cargo capacity produced globally each year, up from just 5% in 1999. That gain came at the expense of shipbuilders in Japan and South Korea. US shipbuilding peaked in the 70s and now accounts only for a small part of the industry output. The draft executive order dated February 27 and reviewed by media on Thursday proposes fees should be imposed on any vessel that enters a US port, regardless of where it was built or flagged, if that vessel is a part of a fleet that includes vessels built or flagged in China. Also, this draft executive order calls on US officials to engage allies and partners to enact similar measures or risk retaliation. So all in all, it will make huge impact at not only container shipments, but also bulk shipping. USA fertilizers importers already are very much concerned regarding how this will influence imports for the season that is expected to put a record of corn production and thus a record of urea imports. So let's see how the situation develops. The Baltic Exchange Rate Index continued its upward correction. Capesize market kept the strong momentum of the last week and showed promising results in both basins. In Panamax segment, the activity was healthy, however rates in both basins failed to improve. In Ultra-Supramax segment, the week was quite mixed and rates stayed rather flat. In Handysize segment, performance was mixed also, with modest movements observed across both basins. To sum up, bearish sentiment in urea is spreading across the regions, but it will be short-term until India finally comes out with a tender. This might happen any day now. Traders started to send vessels to the US while waiting for the tender announcement, which influenced further downward correction at Nola. But in general, activity was slow, as producers didn't want to draw the market down. Nitrates prices stabilized, and the active purchasing season is coming to the end in Europe, while application is on the way. Sulfate market was stable to slightly softening, with weak demand and general bearish sentiment in nitrogen weighing on prices. Phosphates price level remains stable, elevated, with even signs of potential upward correction. And going over the roof sulfur price is one of the influencing factors. Ammonia price slipped further across the regions amid weak demand. European gas price dropped sharply and will most likely stay around this level further during the year. Gas price in the US increased to the highest level in the last 2 years due to very strong LNG stream, and this trend is expected to stay in place in 2025. Agricultural commodities future prices rebounded after a sharp drop, mostly amid news related to tariffs postponement. Container shipping costs dropped again, while healthy activity in bulk shipping resulted in increasing rates, especially in Capesize segment. So let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.